How are transactions in non-financial assets different from expense? The answer is transactions in non-financial assets leave the level of net worth unchanged, while expense decreases its level. With an expense, government does not acquire an asset in return. Resources that are expensed are simply gone from the balance sheet. Acquisitions of non-financial assets, in contrast, lead to the recognition of a new asset or an increase of the value of an existing asset in the balance sheet. If the government, for instance, spends money on the construction of a road or to acquire a medical helicopter, it receives an equal value asset in return. Let's now look at how transactions in non-financial assets are integrated in the GFS framework. The main aggregate in the GFS framework that covers transactions in non-financial assets is net investment in non-financial assets. This is actually composed of three different types of flows. The acquisition, that is the purchasing or producing of non-financial assets. The disposal, that is the selling or transferring of non-financial assets. And the consumption of fixed capital, that is the value lost through wear and tear as those assets are used over time. The formula to determine the net investment in non-financial assets is acquisition minus disposals of non-financial assets minus the consumption of fixed capital. You can visually distinguish net investment in non-financial assets from expense because it sits in the lower block of the GFS framework beneath the net operating balance. This lower part is called the integrated balance sheet. Everything that is recorded here will change the composition of the balance sheet. For instance, the acquisition of a non-financial asset, say an ambulance, will reduce the stock of cash and increase the stock of non-financial assets. Let's briefly go back to the terms expense and expenditure. Many analysts are interested in analysing total government spending, that is, both current and capital spending combined. To accommodate this request, the GFS framework includes expenditure as a second spending aggregate. It is the sum of expense and net investment in non-financial assets. With the concept of expenditure, you can also derive net lending, net borrowing directly as revenue minus expenditure. So please pay attention when using the terms expense and expenditure, as they each have a specific meaning in the GFS framework.